Explain to us exactly what the regulators are going to propose.
Yeah, so they've long held this view in Volcker that transactions violate the ban on prop trading. This is Wall Street making trades for themselves rather than for their clients. And unless you could get sort of authorization from regulators that a short-term trade was to hedge a position or to make a market for a client, the presumption was that those trades were banned. Now that's being flipped, and the presumption is that most short-term trades are in compliance with Volcker, and the only way you get in trouble if you're a bank is if a regulator comes and challenges you later on. Now, the upshot of all of this was, that Wall Street said the rule really missed the mark. The original rule really missed the mark in how Wall Street engages every day. Markets are fast. Clients are, requesting things on the fly. And if you have to sort of mull deeply and talk to your compliance department about whether this bans the Volcker Rule or not, it was a big pain in the neck that made no sense with the way modern markets function.
Jesse, explain how that works as a practical matter in the real world, because a 60-day rule at least has the advantage of being a bright line. At least there's a line there. If this is really a subjective intent question for the banks, how does the bank know how to comply, and how does the regulator know how to enforce that?
Well, that was their point, that banks said, we can't comply with this. We think all of these trades are done for clients, but how do we prove that to our regulators? And how do regulators have the bandwidth to, look at all these transactions and make their own judgments about whether this is a trade that's done for the benefit of the bank to boost its own profits, or something that is done primarily for a client? So the argument of the sort of Trump regulators is, we're going to simplify all this, we're going to make it more complex. We trust that banks, their intent is to comply with Volcker. Their intent is not to violate Volcker. So it's a pretty major shift from what we saw in the Obama administration.
We are also seeing this shift in Congress with lawmakers trying to ease the burden on smaller lenders. Are we going to see such actions in this so-called Volcker 2.0?
Well, that's a little separate than from the Volcker 2.0, which is what regulators are calling their work on revamping Volcker. Yeah, Congress is poised to exempt every bank with $10 billion of assets from all of Volcker. Now, I mean, this always raises a bit of an eyebrow with me, because I don't know to what degree banks that small are engaging in prop trading or making speculative bets, or even to the degree that they have trading desks that are serving clients. But there's obviously some problem here that Congress is trying to fix.
So this seems like the first step in a long process. Where does it go from here?
Yeah, so end of the month, there's 5 agencies that are responsible for Volcker. It's a total Washington alphabet soup of the Fed, the SEC, all these other agencies. They'll come out with a proposal. They'll seek public comment on that for days and or months. They'll rewrite the rule to address issues that they think commentators have made that are valid. And then at some point, we will get a new Volcker Rule that Wall Street will most certainly welcome, because they really don't like the old Volcker Rule.